So President Trump seems to be upsetting the entire world economy and really has changed things dramatically on the world stage vis-a-vis the United States and tariffs, taxation, and everything else. And today we're going to discover, is this good or bad? Is there good that's coming out of this? Is this permanent? Is it temporary? What can we expect in the coming months and years from all of the Trump economic changes worldwide? And I have with me today on the Wealthability Show one of my very close friends, Richard Duncan, my favorite economist. And Richard, welcome to the show.
Hey, Tom, thank you. It's great to be back on. Thank you for inviting me. Very good to see you.
Good to see you too. And thank you for joining us from Thailand. I know you think you love Asia, you love Thailand. You've spent a lot of your life over there, including, I think, time with the World Bank. Is that correct?
That's right. I worked for the World Bank, but at that time I was living in Washington for a couple of years, working for them there.
So just give us a little of your background, Richard, because it's pretty impressive. People don't understand quite how much you've gone through to get to the place you are knowledge-wise.
Okay, so I went to Vanderbilt University, and after that was very lucky and got to travel around the world as a backpacker for a year. And this was 1983, 1984. And I saw Asia for a couple of months at that time, and it was booming economically even then. And so I realized, go east, young man. So I went back to the US and went to business school at Babson for a couple of years, and then flew out to Hong Kong and found a job as a securities analyst working for a Hong Kong Chinese stockbroking company. And I've been in the finance industry ever since then, since 1986, initially as a securities analyst, then as an economist and a strategist. I worked on the sell side as well as later on at the buy side. And eventually I ended up being the global head of investment strategy for a very big Dutch fund management company called ABN AMRO Asset Management, based in London, looking at all the asset classes globally. And along the way, as you mentioned, I worked for the World Bank for a couple of years, and I've written 4 books. The first one was more than 20 years ago, called The Dollar Crisis. And the most recent one was about 3 years ago now, called The Money Revolution. And 11 years ago, almost 12 years ago now, I started Macro Watch. Macro Watch is a video newsletter that I sell on a subscription basis. Every couple of weeks, I upload a new video discussing something important happening in the global economy and how that's likely to impact wealth, stocks, bonds, property, currency, commodities. So that's my story.
No, thank you. It's obviously very impressive. It's great to have a real economist on the Wealthability Show because I think that macroeconomics has such a big impact on our daily lives, really, and particularly from an entrepreneur standpoint, our listeners, primarily entrepreneurs and investors. So here's the kind of first question, and I don't want to get too deep into it, but I want to set a baseline for what's going on. For the last, it seems like at least the last 30 years, the economists of the kind of the generally economic thinking has been what they call Keynesian economics. And could you give us, I know I'm asking a lot, Richard, but can you give us just a thumbnail sketch of what does Keynesian economics mean versus, and then we'll talk about what's going on today, which seemed to be having some upheaval in that theory.
Okay, well, so Keynes argued that in times like the Great Depression, when he wrote his famous book, The General Theory, that it would be wise for the government to borrow money and spend it to stimulate the economy, to pull it out of a recession, out of the depression. But then when the economy recovered, Keynes advocated that the government should run budget deficits, spend less than its tax revenues, so that over time the budget would come back into balance. And so starting in the 1960s, the politicians in the US and around the world, really, they only adopted half of Keynes' policies. They had the big budget deficits to stimulate the economy on an ongoing basis, but they never had the budget surpluses to bring the budget back into balance. So that's really what we've been operating on for, since the 60s, I would say. Eisenhower and Truman were the last ones who tried to keep things in the budget in balance. And so we're still on that path today with only half Keynesianism, which makes it a very bad policy. With the passage of the One Big Beautiful Bill Act, this ensures that we're going to continue with this very large budget deficits for the next 10 years, providing stimulus for the economy and making it grow, but at the cost of ever deeper debt. So we haven't changed course with this new administration. It's in that respect, anyway, we're still in the half Keynesian economic policy strategy.
Right. Easy to spend money, hard to save it.
That's right.
Yeah. I mean, that's what it comes down to, right? So, so back in April, when Trump announced his tariffs, Liberation Day, so to speak, pretty much every economist in the world hated Trump. It was very much the tariffs are horrible. We're anti-tariffs. This is going to destroy the world. There's just a lot of doom and gloom. And nobody thought he could pull it off. I mean, at least none of the economists thought he could pull it off. And yet now it seems like he's pulling it off. So it looks like he's changing the nature of international trade through the EU deal, through the Japanese deal, and it looks like all the other countries are in UK, and seems like they're falling in line.
Yes, so I mean, you have to remember on Liberation Day, the tariffs that he announced were something like 50%. Shortly thereafter, they were 145% on China or higher, right? So they were extraordinarily large tariffs. And the stock market started crashing and the bond market started freaking out. And so a few days later, he backed off all that and just said, okay, 10%. And then things calmed down and started to recover. And then there was a 90-day pause to allow for negotiations. And that was extended until August 1st. And so now we are getting some trade deals that have quite significantly high tariffs, somewhere around 15% on Japan recently, and on the EU, higher on China, somewhere between 30 and 50%. And it's varied on other countries. But yes, these are really quite high tariffs, certainly compared to what we had before, when they were less than 5% on average, 2, 3, 4%. Now they're more like 18% average tariffs at this point that we've imposed on the world, you could say.
So how do you think that changes the world economic landscape?
It changes it just almost 180 degrees in one important respect. Now, the big change that's happened, you could say, in the modern era, as defined by my lifetime, is in 1971, the US stopped backing dollars with gold. And soon after that, in the early 1980s, the United States discovered it could buy things from other countries and it didn't have to pay with gold anymore. When it had to pay with gold, there was a limit. The US couldn't have a big trade deficit, in other words, because when dollars were backed by gold, if the US bought more from other countries than it sold to other countries, it had to pay for that deficit with its gold. And gold was money. So if it ran out of gold, it ran out of money and the economy would have collapsed. So trade used to balance right up until the breakdown of the Bretton Woods system and a few years beyond that. But in the early 1980s, the US realized it didn't have to pay with gold anymore. And they started having these very big trade deficits with the rest of the world, starting in the early 1980s under President Reagan. Reagan had very big budget deficits, and that stimulated the US economy. But under President Reagan's 8 years in office, the US government debt tripled. And that created an enormous amount of stimulus for the US economy. And the United States, with that stimulus, that meant Americans had more money, they spent more, they consumed more. So the US started importing more and more and more from other countries. And suddenly our trade deficit went from zero to very large levels. It kept getting larger and larger. The highest up until now was 2006, when it was $800 billion, the trade deficit. But last year, it's grown again to a new peak of $1.2 trillion. And altogether, since the 1980, our cumulative current account deficit, which is more or less the same thing as the trade deficit, has been $17 trillion. And this has thrown out $17 trillion into the global economy that the global economy wouldn't have received otherwise. So this has allowed countries, I've lived in Asia most of my adult life now, Hong Kong, Singapore, Bangkok, a few times each. And I've watched this Asian miracle. Asia has been completely transformed by having this enormous trade surplus with the US. That's why China went from being a very, very poor country when I first saw it in 1986 to being the world's second superpower now, nipping at our heels and really becoming a real grave threat to US national security because it's growing so rapidly. And so this has caused the greatest global economic boom in history, the US buying $17 trillion of goods from other countries and paying for it all with credit. It's created a big global boom, but it's also created a big global credit bubble. And this has benefited the surplus countries, but it's also benefited the United States, because when a country like China, the Chinese manufacturer sells his goods in the US, he gets paid in dollars. So these surplus countries, they get paid in dollars. So this $17 trillion that went abroad, they have these dollars, and they have to invest these dollars in US dollar assets like government bonds, which makes it easy for the government to finance big budget deficits. And when when the rest of the world buys government bonds, US government bonds, it pushes up the bond prices and it pushes down interest rates. And low interest rates are good for everybody. And they don't only buy bonds, they also buy stocks. So that pushes up the stock market. So this the trade deficit is exactly equal to the capital inflows that come into the United States. So last year, the trade deficit was $1.2 trillion. So we had $1.2 trillion of capital inflows coming into the United States, buying government bonds, pushing up their price, driving down their yield, pushing up the stock market. And so that's been very beneficial to the US in that respect, but also by buying things from other countries with very low cost labor, like China, now Vietnam and Bangladesh and India, this pushed down the price of goods. So it held down the inflation in the United States, even though the US government had very big budget deficits, which in the pre-Bretton Woods days, during Bretton Woods, big budget deficits would have overstimulated the economy and led to high rates of inflation. And also the US has gotten away, at least in 2008, it got away with having enormous amounts of paper money creation by the Fed to pull us out of the global financial crisis in 2008. And there was no inflation after that, despite the Fed creating $4 trillion in just a few years and having budget deficits that were $1 trillion a year in 2009, 10, 11, 12. There was no inflation because globalization was so disinflationary. It pushed down the prices and pushed down inflation. So that's the background setting. That's the world that we've lived in. This has been the paradigm for 40 years. The US trade deficit has been the driver of global economic growth and of US economic growth.
And yet you've written you've written that you're not such a big fan of this, even though it has pushed up. So what's the downside to this?
The downside to the old system or to the new system we're moving into?
The current system that we're in, the old system, the system of continuing increasingly big trade deficits and budget deficits.
Well, there are a number of downsides. For one, it's turned China into a great superpower that's now on the verge of overtaking us technologically, economically. And
so we funded their growth.
We made them into a very powerful enemy that now threatens us at a national security level in a way that most Americans truly don't appreciate. So that's a downside. Another downside is that when this all began, it started hollowing out the American middle class because all of the US factories moved overseas, and that left all of those factory related jobs, they were all gone. And so the standard of living for the middle class really has stagnated now for decades. And that's led to a lot of resentment among a very large part of the US population, which has led ultimately to populism and growing and to this Trump revolution, the election of President Trump, who promised that he would reverse all this. And so that's another downside, that it's the middle class has been worse off as a result of this, or at least relatively worse off. So that's a problem. And also this arrangement has also led to increasing income inequality, which is, in my opinion, also a big problem, because just a handful of, soon we're going to have zillionaires. Elon Musk is worth $400 billion, depending on what the share price of Tesla does from one day to the next. But when the man has $400 billion, you can basically elect, you can definitely get 51 senators elected on your own. And so that's not democracy. And that's just one problem with income inequality. So there are a lot of downside risk. And maybe I'll top this off with saying that this has created an enormous global credit bubble that must have more credit and more credit and more credit to survive. If the credit stops growing, then this bubble implodes. Like we started to see in 2008, in 2008, I know it seems like ancient history now, but when the Americans couldn't repay their mortgages, all the banks started to fail. Fannie and Freddie did fail and had to be taken over. All the other banks had to be bailed out. Had they not been bailed out, they would have collapsed, as they did in 1930 and 1933, and we would have been back in a new Great Depression. So this new system, I call it creditism rather than capitalism, because it depends on credit growth to keep it inflated. This is a very negative consequence of this arrangement, because now we're so vulnerable. If this thing pops, it will have truly, truly catastrophic consequences for our civilization.
So, Richard, what could cause it to pop? What are the pins that could pop that bubble?
Very large trade tariffs.
Is that right?
Because that would cause the U.S., in theory at least, if these tariffs are successful in bringing down the trade deficit, which is one of President Trump's goals, then that means that this credit that has been coming out of the U.S. trade deficit is going to get less and less. So as the U.S. trade deficit becomes smaller, the other countries will earn less money, so they'll be poor, but they also have fewer dollars to invest in U.S. government bonds and U.S. stocks. So that will mean that bond prices would fall and interest rates will rise. And if they buy fewer U.S. stocks, that means the stock market will fall. So to the extent that this policy is successful in reducing the U.S. current account deficit or eliminating it, this would be more than enough to pop this global 4-decade-long credit bubble that we've been living in all of our lives. So yeah, that's a real threat. But most likely, these policies are not going to bring down the trade deficit very substantially, because after the One Big Beautiful Bill Act was passed, the deficits are going to become so much larger, they're going to provide so much stimulus to the economy that Americans are going to have more money, so they're going to continue consuming, and by consuming, they're going to continue to import. So the trade deficit is probably not going to get very much smaller, but in the absence of these trade tariffs, the trade deficit would have become much larger because of the very large budget deficits that we're now destined to have for the next.
Let's talk about this for a second, because I'm a little familiar with this One Big Beautiful Bill, given that it's primarily a tax bill. And so here's the thing, though. Are Americans really going to have more money than they have now? Because most of that deficit, in fact, pretty much all of the deficit in that bill, is a result of continuing policies that have been in place for the last 8 years. They're not new policies. The only two significant new policies that are not that would put money in well, maybe three people's pockets are an enhanced child tax credit, which definitely puts money in their pocket, the no tax on tips and the no tax on overtime. And those would put money in those in pockets of people who do spend that money. I mean, they're really not savers, they're spenders because there's a limit on those. But outside of that, there's really nothing new in this bill that wasn't already in 2017. So how do what makes you think that, and in fact, it actually, the deficit cost of this bill is less than if all we've done is continue the 2017 tax law. Okay, it's actually, the deficit's down $800 billion, excuse me, $800 billion from what it would have been had all they done just extended the 2017 Act. So what is it that you're seeing that you think, oh, well, this is going to continue to put pressure? Is it just the fact that it's not going to restrict them?
Well, you're right. I agree with what you said. It doesn't really provide that much additional stimulus, but by ensuring that the budget deficit continues to grow from, I mean, last year, the budget deficit was $1.8 trillion. By 2034, it's supposed to be $3 trillion. Now, this is before tax revenues from tariffs, and those are going to be substantial. Those could be as much as $600 billion a year. So rather than being $3 trillion, it could be $2.4 trillion 10 years from now. But still, $2.4 trillion is going to keep growing. The budget deficit is going to keep getting bigger, it looks like anyway, every year. And that's sort of huge budget deficits on those scales. We've never had budget deficits this large during peacetime, or at least unless we're in a very severe recession, except when President
Reagan. But you think that'll keep that spread going, that bond market going?
Well, it will keep the economy
inflated.
With the government pumping in an extra more than $2 trillion a year of additional government stimulus or debt, ongoing stimulus is going to continue to support the economy, and that should continue to support consumption, and that should continue to support Americans importing from abroad. So I don't expect the trade deficit to disappear, which is a great thing from my point of view, because if it did, the capital inflows into the U.S. would disappear. This 40-year paradigm that we've been living in, where this U.S. trade deficit has been flooding the world with dollar liquidity and creating this giant credit bubble, that whole paradigm would have collapsed into a catastrophic new Great Depression if the trade deficit did disappear.
So what do you see the impact of the tariffs being on the worldwide economy?
Well, clearly,
now that they've settled to that 10 to 15% range, except for China.
Yeah, so things are changing so quickly. It's difficult to take it all in, and I'm sure things are going to continue to keep changing quickly. But so let's talk about the tariff. Let's say a country let's take Japan. Japan, the tariff rate's 15%. All right, so there are three possible scenarios in terms of who's going to pay for this tariff. It's possible that the Japanese manufacturers will reduce their cost, their price of their goods that they sell to the United States by 15%. And in that case, their profit margins would shrink and they'd probably go bankrupt. But that scenario, they would be paying it all. That's one scenario. They'd be paying the tariff tax, in effect. They'd still be selling their goods in the United States, but they'd be selling it at 15% a lower price than they sold before. So they would be poor. So in that scenario, they're the losers. But some of that may happen. I've seen estimates saying that currently maybe 20 maybe the foreigners are eating 20% in that way. But the reality is that whoever imports the goods into the United States, whoever brings the goods into the US, like Apple, if Apple brings the telephones in the United States from China or wherever, Apple pays the tariff,
Right.
whatever the tariff rate is, 30% on iPhones, I suppose, since they're all made in China. And then Apple has to make the decision. Does it take a 30% loss on its margins, or does it pass the whole thing on to the consumers and make the phones 30% more expensive? And in the first scenario, Apple would be the big loser, and their profits would fall, their profit margins would fall, and presumably their stock price would fall. But if they pass the entire thing onto if they pass the entire tariff tax onto the consumers, then the consumers would pay 30% more for their iPhones, and the consumers would be the losers. So in the end, it's going to be spread out between these three. Now, the foreigners are going to, but now think about the foreigners' point of view. If this was just imposed on one country, like China, then the United States could buy products from other countries,
Right.
more cheaply. But these tariffs you could call them universal. So the Americans cannot produce the things that they buy. But most of the goods that the Americans buy are made in factories overseas. And that may be able to change gradually over the next 5 to 10 years. But next year, there aren't factories to make iPhones in the United States, or the other, again, our current account deficit was $1.2 trillion. That's not going to change overnight. So now the foreigners are sort of all in the same boat. Why would any of them reduce their profit margins? Because the Americans have to buy these products from some foreigner. They can't make them at home. So why should the foreigners cut their profits? There's nowhere else for the Americans to buy their Christmas gifts from. They have to buy them from overseas for the next many years anyway. So most of this tariff tax is going to be borne by Americans, either the American companies who bring in the imports and pay the tax at the border, or the American consumers. So it looks like inflation is going to pick up because of these tariffs. And that's going to be interesting for a number of reasons. But we've started to see, naturally, if you put a 15 to 30% tariff or 15 to 50% tariff on imported goods, the cost of goods in the US is going to go up. And so that's the first round effect, that just the tariffs themselves will make things more expensive. But then you come to a second round that could potentially just be a one-off sort of hit. But then you come to the second round effect. If the United States actually begins to try to build factories in the United States to make these goods itself, then that's going to lead to very low rates of unemployment. The unemployment rate in the United States is extremely low already, 4.1%. We have a labor shortage at this point. And on top of that, we're deporting potentially millions of people over the next couple of years. So there's going to be a labor shortage. So the second round effect is, if the American businesses begin building their own factories in the US, this is going to push up wage cost and push up material cost. Of course, the cost of steel and the cost of copper and aluminum, there are 50% tariffs on all of those things at the moment. And so this is going to be the second round effect, where you get higher leading to a wage push inflation spiral. So it's very probable that we're going to see a meaningful increase in inflation. The inflation rate, CPI, Consumer Price Index, was 2.4% last month, or May, I should say, which was fairly close to the Fed's 2% target. But then in June, it moved up to 2.7%. It's likely to keep moving up into the threes and probably into the 4% range. And the Fed's duty, its mandate, its official mandate from Congress, is to hold down the inflation rate and also try to maximize employment at the same time. So if the inflation starts moving up to 3-4%, the Fed's definitely going to increase interest rates rather than cutting interest rates. Right now, the federal funds rate is around 4.3%. And President Trump very badly wants the Fed to cut that as much as possible and as soon as possible. But the tariffs are pushing up inflation, and they're likely to push it significantly higher. So the Fed is going to be more prone to hike interest rates during next year than to cut rates. This is going to lead to a very interesting situation because President Trump tends to get what President Trump wants to get, it seems to me. And what he wants to get is lower interest rates. So the Fed chairman, Jerome Powell, his term doesn't expire until, as Fed chairman, doesn't expire until May next year. But President Trump has been threatening to fire him, most recently suggesting that he could be fired for cause for budget overruns on renovating the Fed building in Washington.
Right.
But so it looks like we're moving toward a showdown between President Trump and the Fed. And as I said, President Trump seems to get what President Trump wants. And there are many ways that he can get what he wants. So there's a real possibility. 6 months ago, I made a Macro Watch video called "Will Trump End the Fed?" And we're very much, that won't be enough just to replace Chairman Powell with someone who will do the president's bidding. Trump will be able to appoint the next Fed chairman. But there are 12 other Fed governors or 11 other Fed governors and presidents who rotate and vote on the level of interest rates. And just because he replaces chairman doesn't mean he controls the whole Fed. So more recently, we've heard Treasury Secretary Bessent begin talking about the need to restructure the entire Federal Reserve System. So we may see some really, really aggressive moves by the Trump administration that ends up effectively recreating the Fed or removing it altogether. In theory, the Treasury Department could do what the Fed does now. You know, the Fed wasn't created until 1913.
Right.
Before that, the Treasury Department created the money and did all of the things effectively that the Fed does now. We could revert back to a world, if push comes to shove, where the Treasury Department takes over as the issuer of money. And
what do you see as do you see as the downside to that? I mean, it seems to me one of the challenges with the Fed is it's controlled by the big banks. It's owned by the big banks, and so you could say that the big banks really control a lot of the monetary policy. So what do you see as the downside to the Treasury taking it over?
Well, you could say the big banks control the Congress as well, without too much exaggeration. The big banks generally get what they want because they give a lot of campaign contributions to the people who matter. And so the downside to this is that if you have an inflationary environment to start with, where tariffs are pushing up prices and big government budget deficits are stimulating the economy and pushing up prices, and you have a labor shortage at a time when the US is reindustrializing, pushing up wages and pushing up prices, and your cost of steel, aluminum, and copper are 50% more than they were a month ago, then you're in quite an inflationary environment to start with. If you then, so even if the Trump administration completely takes over monetary policy, they could cut the federal funds rate, the interest rate that the Fed controls. They could cut that as much as they wanted. and that would provide a lot of additional stimulus, but that additional stimulus would create even more inflation.
Right.
So the real problem is they can control the short end of the interest rate curve, but they can't directly control the long end. They can't control the 10-year bond yields. No one's going to want to own a 10-year government bond that yields 4% if the inflation rate is 5%.
Right.
So if the inflation rate is 5%, the 10-year government bond yield would probably be 7% or higher. In that environment, what's the Trump administration going to do? They're going to have the Fed or the Treasury Department or whoever's controlling monetary policy on their behalf. They're going to have that institution do another big round of quantitative easing, create a lot of money to buy government bonds, to push up the price of the government bonds and push down the yield on the 10-year government bond. And in that way, they can push down the 10-year bond yield as well as the short end. They can hold down short-term rates, they can hold down long-term rates, and this would create a big, big economic explosion, boom in the US, but it would be highly inflationary. And it would, among other things, I mean, it would create a lot of wealth, but it would the dollar would devalue very sharply against other
which is really just a horrendous tax on the middle class and the poor. I mean, that's really what it ends up being, that it's a very regressive tax, inflation, and horrendous, particularly on people who are on a fixed income budget, like Social Security recipients, et cetera. So not a pretty picture. What do you see? What positive could come out of these policies, do you see?
Well, one thing that I think is very positive about these policies is really that one of the main goals of this entire strategy is to stop China's economic growth. The chairman of the Council of Economic Advisors to President Trump is a man called Stephen Mirren, and he published a paper back 6 months ago called A User's Guide to Restructuring the Global Trading System. And this is a paper everybody should read because it lays out the exact strategy that we've seen play out, this tariff strategy. It's a three-step plan with two objectives. The three-step plan, step one, you put very high tariffs on all the other countries in the world. Step two, you threaten all the other countries in the world that if they retaliate, we'll no longer protect them militarily. So, if the EU retaliates, we'll let Russia take over Europe. We'll no longer abide by our NATO commitments. And the same thing goes for Japan and South Korea and everybody else. And step three then is to essentially have these trade negotiations with these terrified trading partners and make them agree to these high tariffs without retaliation, but also to a devaluation of the dollar. And also, importantly, to try to make them put up very high trade barriers against Chinese goods, just like the US has very high trade barriers against Chinese goods. The objective is to build a tariff wall that encloses China within China in order to stop China's economic growth so that China will not become more powerful than us and take over the world. So that's the objective. One part of the objective is to isolate China and stop its growth. And the other more publicly stated part is to reindustrialize the United States.
Right.
So I think it would be a good thing to stop China's economic growing threat to the United States because it's very serious. And if they win the AI race, it could be done, they'll rule the world in short order, and they're neck and neck with us. So it's a very dangerous situation. So that would be good. It also makes sense for the United States to be much more industrialized so that we can have materials that we need, for instance, ships and steel, the things that are necessary to have if you're going to get involved in a war one day, which presumably we will, since we've always have in the past. So we need to have domestic sources of the supplies that we need. So that would be good. But the danger is that if things go wrong, and if our global
Yeah,
credit bubble is so fragile that if it pops, we could go seriously spiral into a Great Depression, and everyone would be worse off in the U.S. and around the world. And that would probably lead to global conflicts, just like the Great Depression led to World War II.
yeah.
It's a very precarious time.
It's interesting though. If you kind of look over history and you see great industrial powers that have, fallen off, like England, UK, right? They seem to have, what they've done is they just pushed their industrialization offshore, and all of a sudden they don't have the industrialization onshore, and they've lost their power of investment. And it's just not happening, which makes me want to turn to Trump's idea of a sovereign fund from an investment standpoint, because this is, I see this. From the big beautiful bill, the biggest provisions, the big beautiful bill, are all about stimulating manufacturing and in industry in the U.S. That's the full expensing, the bonus depreciation, the research and development expensing. Those are really the two biggest stimulus. A lot of the stimulus is business stimulus. A lot of chatter about the tips and so forth, but the bigger stimulus is the economic stimulus to the businesses. And so if you look at that, and then you go, okay, now Trump's got Japan, he's EU now looking at actually tagging on to basically using them for a sovereign fund for the US. First of all, can you explain it? And second of all, let's make this our final segment and talk about what you think of the idea of a sovereign fund.
So, can I explain it? I can't explain it because no one can explain it because the details haven't been released. It seems to be more of a concept at this stage. Now, these trade deals so far are more or less just written on the back of an envelope. It seems like the details haven't been worked out because, as you can imagine, the details are so complex, it normally takes years to work out comprehensive trade deals with other countries. So I can't explain it in detail. But in terms of a sovereign wealth fund, I think that is a fantastic idea. As we've discussed before, my last book was called The Money Revolution: How to Finance the Next American Century. And in fact, here it is. It's 500 pages. And the whole purpose of this book, which was really hard to write and took a very long time, is how to finance the next American century. How to finance it is to have a U.S. sovereign wealth fund for the U.S. government to invest in new industries and new technologies on an extremely aggressive scale in all the industries of the future, starting with AI and quantum computing and robotics, neuroscience, genetic engineering, biotech, all of the industries of the future. That was the theme of my book. So when just under a year ago, when President Trump said he was in favor of a U.S. sovereign wealth fund, I thought that was the greatest thing ever, because that was what I've been advocating for years now, and the whole entire theme of my book, that the U.S. can afford to do this, the U.S. must do this, and pointing out the extraordinary benefits that this sort of investment on a very large scale, financed by the government and carried out by the private sector, this will produce such extraordinary technological breakthroughs and rev up U.S. economic growth to a much higher level than we've been experiencing in recent years, improve U.S. productivity, and ultimately lead to extraordinary technological breakthroughs that will not only shore up U.S. national security and ensure that we continue to be in control of our own destiny, which is now at risk, but also medical breakthroughs that will, cure all the diseases, cure cancer, cure Alzheimer's, extend healthy life expectancy by decades. This is the sort of things that we could accomplish with a large enough sovereign wealth fund. So the bigger the sovereign wealth fund, the better, as long as it's invested in the cutting edge technologies, the industries of the future. This is the path forward for the United States. So I'm really thrilled about these announcements.
That's
when
awesome.
I first started talking about this stuff 2 decades ago, people would say, well, that's an interesting idea, but that's never going to happen. And gradually, year by year, we're moving more and more in that direction. So I do hope that is the way forward. I mean, I believe that's the way forward. I believe that's circumstances demand it. Either we do this, or because China has been doing it so aggressively and so successfully that they are growing. They invest more in technology, research and development in technology than we do now. And that's why they have.
And we've seen this in China. We've seen it in Saudi Arabia. We've seen it in actually Kazakhstan has actually done a terrific job reinvesting their oil back into their infrastructure and their economy. So it's a very interesting idea. Richard, so much we could go on for days here, but it would get really late there in Thailand if we did that. So where can we get more information and really tap into your current thought process on a regular basis?
So the best way to do that is to subscribe to my video newsletter, Macro Watch. As I mentioned, every couple of weeks, I upload a new video discussing something important, like the things that we've been discussing tonight. The next video is going to be on tariffs and their impact on capital inflows in the United States. And the one after that, the impact of tariffs and inflation and the coming battle between the Fed and President Trump, and how all of those things are likely to impact wealth and asset prices. So to find MacroWatch, it's on my website, which is richardduncaneconomics.com. Just Google richardduncaneconomics.com and subscribe to MacroWatch. You'll get a new video every couple of weeks. You'll have immediate access to more than 100 hours of MacroWatch videos in the archives going back to 2013. And I'd like to offer your listeners a subscription discount, a 50% discount. If they hit the subscribe button, they'll be prompted to put in a discount coupon code. If they use the coupon code ABILITY, they will be able to subscribe at a 50% discount. And I believe they'll find it really quite affordable. We're not talking thousands and thousands of dollars. This is really very affordable. So I hope your listeners will check it out, richardduncaneconomics.com, and subscribe to MacroWatch.
I love it. Richard, thank you so much for taking time out of your very busy schedule. And thanks everyone for paying attention to, while we frequently talk about microeconomic, what's going on in your daily life, the macroeconomic picture has such a long-term and really in many ways immediate effect on your short-term plans for your business, that the more we can get on the macro, I think the better off we are. And when we do that, we're always going to make way more money and pay way less tax. We'll see you next time on The Wealthability Show. Thanks for listening to The Wealthability Show. If today's episode gave you a new perspective, remember this: the tax law is not your enemy. It's a roadmap. And when you know how to follow it, you can build real, lasting wealth. If you're a business owner or investor who's tired of overpaying taxes, the Wealthability Accelerator is your next step. You'll have the opportunity to work directly with me for 80% less than my standard rate. And I'll personally guide you through how to change your facts so that you can change your tax. Go to wealthability.com/bonus and apply today. Remember, it's not just what you make, it's what you keep.
This podcast is a presentation of Rich Dad Media Network.